daily on Bloomberg Quint.
Back with IndianOpen right here on Bloomberg Quint. Let's take a quick check at how the Asian markets are faring for viewers who are tuned in right now. It's a mixed bag. Actually, Shanghai has improved a little bit from the levels that it was trading at. Nikkei was down about 0.8% at the start of the show. It's now down 0.63%. Has the SGX Nifty improved a bit too? Maybe at the margin, slightly higher. But let's wait and watch. Remember, the US markets did well yesterday, but post that there have been developments which only aggravate the situation between US and China. So let's wait and watch what happens during on open. A lot of times these days, the SGX Nifty ceases to be the lead indicator. The markets have behaved, even at open, very differently from what the SGX Nifty tends to suggest. But what will also be important is the derivative space, more so today. This is the penultimate expiry, actually the last expiry before elections, because next time around, before the expiry happens, we may well know the outcome of the election results as well. So, important Thursday. Agam Bakhali is standing by with the setup of the derivative space. Agam.
That's right, Meera. It's going to be a very, very important 1 week for the futures and options space. Perhaps the most important week in over 5 years now, considering this is the first time we have the options expiries for the weekly options expiry for the Nifty too. So we're most certainly likely to see a lot of volatility, but I'm going to come to that in just a bit. Let me just quickly address the fact, and this again is a very important one, that we are seeing unwinding in a lot of these futures. And it's not only because the markets are going up and down. A lot of traders will be of the opinion that it is better to take money off the table as we move into a week which may see sustained volatility and with very sharp up as well as down moves. You know, as was the case yesterday, while we began the day of trade in the green and we eventually ended up with the red, and that reversal is also very well possible and on the cards on each and every single trading day of this upcoming week. So this is as far as Nifty is concerned. The Bank Nifty, again, we're seeing unwinding. But as you can see, you know, the unwinding number has also gone off and come off to a certain extent. There isn't as much change in open interest over the past 3 or 4 days. And this is a clear indication that traders for now, a lot of them, at least the experienced ones, will look to reduce their position sizes as we move into a very volatile period. And now, speaking of volatility, India VIX rose another 6% at around nearly 29, nearing that 30 mark which we last saw during the 2014 general elections. So and that it seems that at this point in time is in store, it's on the cards. So that said, now this is far as your options distribution is concerned, and this is where things are going to get very, very interesting. Now, as per today's expiry, we are looking at maximum open interest around the 11,300 call. The Nifty currently is around that level, well, slightly below that level, which means for today, there may be resistance around there. In terms of puts, mind you, there isn't very much when you actually consider the way there has been accumulation, which means that at least in 1 week, this coming week, traders are not seeing too much of downside. But this is as far as today is concerned. Let's move in and talk about the 23rd, the 23rd May expiry, and that is the most important one. For now, the way things are stacked up, keeping in mind the 23rd May expiry, that is when we will have the election results out. We're seeing accumulation in 11,500. So for now, that's the range a lot of our analysts are working with. And on the lower end, however, and perhaps surprisingly, we're not looking at too much of a lot of movement, considering we have quite a bit of accumulation around the 11,200 put. And this is a 300-point range that the markets expect the Nifty to move within over the course of the next 1 week. So while there will be very sharp up moves and down moves, this is the 300-point range we are working with as far as this week's concerned. And finally, to take a look at the 30th May, because on the whole, where is the longer-term picture? What happens after 23rd May? As you can see, there isn't much on the upper end. On the lower end, it's 11,000. So it really doesn't tell us much. But what we do know for now is the 300-point range that people may be looking to play as far as this particular expiry is concerned. Do remember the rollovers have not been very high as far as your weekly options go because of the fact that not a lot of people want to take positions as in such a volatile period. This is as far as open interest distribution is concerned for now. Put call ratio at a neutral level of 1.1. Moving on. We can talk about your stocks. Again, Jubilant Foodworks will be in focus. It reversed all the losses it made day before. And SRF and DC Bank, of course, among many others, which are looking at a surge in open interest. And in terms of unwinding, again, keeping an eye on something like Siemens, Bharti Airtel, and Tata Motors. But of course, on the whole, all eyes will be on the Nifty as well as the options and where it may lead to next week's weekly expiry.
Okay, Agam, we'll watch out for these. As Agam put into perspective, a very important expiry considering this is the penultimate one or the final one before we get to know the election results. Watch out. I think the positions in Nifty banks were interesting, and banks are, I think, telling a story, right? They're still looking to find a grip over their financials and asset quality for some time now. And while some of the bigger ones are grappling with the stress, J&K Banks managed to make some headway on growing its business. Shefali is back to tell us what helped J&K Bank shine out in the fourth quarter. Shefali, why is it that J&K Bank is the result of the day today?
Well, yes, the strategy of the J&K Bank has been to grow in that particular state, Jammu and Kashmir, and that has been working for them. So the credit growth in J&K was about 23%. So that's in line with what they've been guiding. The management has been guiding that they'll do around even 25% in FY20 as well. So they're near that mark. Overall credit growth also stood very strong for them, about 16%, deposits growth around 12%, and it's their geographical concentration that's mainly been working for them. Apart from that, what stood out in the earnings was that it was a sale of partial PNB MetLife stake sale that actually boosted their earnings. So that is a reason why the bottom line looks inflated. It has grown by about 7.6 times to about 214 crores. Even on a sequential basis, it has almost doubled. So that's the reason for increase in the bottom line. But other than that, even the net interest income, that is the top line, has grown strongly by about 42%. Their NPA figures also look good. Net NPA is almost stable on a sequential basis. Gross NPAs have come down by almost 1 percentage point on a sequential basis. However, the analyst con call is yet to happen, and what I would want to know from the management is what they've done with the ILNFS account. They state in the press release that they've downgraded the entire account and the holding company and the subsidiaries, and at the time of Q3 they had told the analysts that their exposure is about 1350 crore rupees, out of which 1000 crores they had already downgraded. So the balance 350 crore rupees has been downgraded in this quarter, but I do not see the provisioning to the same extent. Last time they had said, that is at the end of Q3, that they've just made 15% provisioning for the ILNFS account. Now that it's completely downgraded, so the provisioning amount, the total has gone up to just about 378 crore rupees versus about 252 on a sequential basis. So a bit more color on that would really help in analyzing the numbers better. Other than that, on the face of it, numbers look good, but a bit more color on the asset quality regarding the provisioning would be more helpful.
Okay, so that notwithstanding, and I think when the management speaks, one can get knowledge of that. But by and large, the numbers optically seem good. Shefali, thanks so much for putting that into perspective. Watch out, financials by and large seem to have come out with a fairly decent set of numbers yesterday, at least. The ones that I'm talking about are the ones that have come out yesterday. Aside of J&K Bank, I think Manappuram Finance came out with a healthy set of numbers. Magma, I think, had a fairly decent quarter too. So watch out for some of these names. They could be interesting ones to monitor today. J&K Bank is one, but there are others. Some results, some other stocks in news aside of Tata Global and Tata Chemicals, and some results that will come out today. So lots to talk about with our research team. Let me go across and try and talk to Mishika, Agam, as well as Nikki about all the key stocks that will be in focus beyond the ones that we've spoken already. Good morning, all of you. Good morning, yet again. Mishika, let's start off with you first. The stocks in news.
Yes, so the earnings season is almost at an end. We'll first look at the important earnings. The first one being Phoenix Mills, which came in with a good set of numbers. Their revenues are up 66% at 723 crores. Net profit is up 2.5 times at 228 crores. And on the back of an exceptional gain of 48 crores in the current quarter. And other income is up 2.3 times at 33 crores. Then we have Manappuram Finance, which also came in with a good set of numbers. Their net interest income is up 17% at 698 crores, and net profit is up 43% at 257 crores. The board approves to explore entry into micro insurance and to acquire 100% stake in Manappuram Asset Finance. Then we have Gulf Oil Lubricants, which came in with a weak result. Their revenues are up 17% at 436 crores, and margins stand at 17% versus 16.8% last year. Then we have Petronet LNG, which also came in with weak results. The revenues are down 17% at 8,383 crores. Margins stand at 7.5% versus 8.4% last year, and their other income is up 71% at 151 crores. Then we have Lupin. US FDA completes inspection at the Aurangabad facility from May 6th to 15th with 3 observations. Zuari Agrochemicals says on evaluation of market conditions and inventory position, one of the 2 granulation plants of the company will be shut down till further intimation. And lastly, we have Balaji Amines. They've received consent to operate by Pollution Control Board for expansion of existing products and adding 4 new products at the Maharashtra unit at MIDC Chincholi.
Okay. Well, we'll watch out for some of these. Some impact can't be assessed, some of which easy to assess. Thanks, Mishika, for putting all of these into perspective. Well, one more company on which we spoke about briefly about the trends, but what have brokerages made of what Jubilant FoodWorks has done.
Right, Neeraj, so there's a steady set of numbers there, and brokerage is by and large positive. So we have Jeffries. It's maintained a buy, but it has cut the price target by just about 25 rupees to around 1450 from 1475. We have to remember that it's a pretty richly valued stock, and operationally it's a strong number, but they do not rule out a near-term pressure when it comes to same-store sales growth. CLSE on Jubilant FoodWorks again maintains a buy, but cuts the price target to 1500 from 1600. So again, a substantial upside even from current market levels. As same-store sales growth has moderated again, as acknowledged, and Morgan Stanley remains overweight with a price target of 1525, the highest target among the 3. It says the management is confident in terms of the long-term prospects, and the new menu offerings of beverages and pizza is performing well, and that should augur well for the company going forward.
Thanks, Agam, for that. Nikki, what's expected out of Hindalco?
Not a great set of numbers. YOY basis, we're looking at decline. Top line growth is expected to be flat for the company. The numbers that we're working with is around 11,532 crore on the top line. While in terms of EBITDA, we're expecting a decline coming in on 22%. Profitability too is expected to take a hit by as much as 35%. Margins are expected to shrink by 8.5% to 8.5% as compared to 10.5%. Now, this is if you include Utkal in this numbers, just the Indian business plus the Utkal business, in that case, we are working with a decline of 11%, and the number that we'd like to keep an eye out would be in the range of around 1,420 crore to 1,430 crore. Apart from that, the factors which really go behind the making of the numbers now, YY basis, we've seen the LME aluminium prices being lower by as much as 5 to 7%. However, the cost of alumina has declined, and there have been favorable hedges which might just aid or stem the decline of the EBITDA for Hindalco aluminium business. If you look at the copper division, we're expecting a decline there, almost a 10% decline due to lower prices. Also, in terms of Utkal division, we're expecting a decline to the tune of around 25% year-on-year basis. Subsidiaries, as you'd know, Hindalco has reported solid set of numbers. To be subsidiary Alris has also come out with a good show for the March quarter. Things that we like to watch out for would be the lower margins in the aluminium business business, if at all, and outlook thereon, the hedging position going forward of the company, outlook on metals in light of the trade war concerns, and essentially the completion date for acquisition of Alris, given that the European Commission on May 14 has stopped the clock on its in-depth investigation into Novelis' proposed acquisition Alris. So we'd want to see if it meets the same fate as we saw for Tata Steel and Thyssen Group. So that's one factor that we like to keep an eye out.
Certainly we'll watch out for. Nikki, thanks so much for that, as also Mishika as well as Agam. So do watch out for some of these names. Keep in mind, as we said, Phoenix Mills, good numbers, but there's some anomalies, and I'll talk about that in a bit. And watch out for Petronet LNG, weak set of numbers. Will be interesting one to monitor as well. But before we start talking about Indian views and get in our technical experts to talk about what the charts are suggesting, because they are really important today, let's get in a couple of global opinion. Morgan Stanley chief economist Chetan expects escalation of the trade tensions to push US into a recession. He also expects the global growth to fall below the 2.5% in 2020 due to these trade tensions. Listen in.
Yeah, so in our base case, we're assuming that there is a possibility that both the countries come together and there is a deal in 3 to 4 weeks' time. If that doesn't happen and trade tensions escalate to a stage where there is additional tariff of 25% on the balance imports from China, calling it that 25% tariff on all imports from China, you are taking a huge risk. We think you will probably in that scenario see a recession in the US, see a recession in global economy, which is basically the global economy will reach below 2.5% year-on-year growth by 2020. I think the big picture, what we are saying is that there are two key forces at play right now. First is that we have this policy easing from the Fed's pivot in the last year, basically in December, brought the financial conditions to be easier by 100 basis points, and China did a stimulus of $250 billion. So that's on one side. On the other side, you have these trade tensions. Now, where we are different from consensus is that everybody, if you see all the analysis on trade tensions, is on what is the impact on growth on a direct basis because of tariff. But what we are highlighting is don't miss the point that trade tensions are really having a serious impact on corporate confidence, serious impact on CapEx.
And we heard this from John Williams yesterday at Bloomberg.
And that part is underestimated. And so when we have seen such a massive collapse in capital goods imports globally, that's the most transparent CapEx indicator. It was growing at 21% first quarter last year, nominal dollar basis, and right now it's contracting 3%. So if you get these trade tensions escalating more than 3 to 4 weeks, that's the one that's going to tip the global growth towards a slowdown.
Meanwhile, emerging market veteran Mark Mobius expects countries like India and Brazil to remain insulated from the trade war. Listen into some of the places where he finds value.
If you look at the trade in Asia generally, the biggest trading partner for most of those countries is China. So if China is going to be importing less, all of these countries are going to be hit. So we have to be very cautious in looking at each and every company in those countries to see whether they're going to be affected by the situation in China.
So Mark, give us a sense of the time frame that you think about when you talk about investing, and particularly when it comes to the China-U.S. trade dispute. If this goes on indefinitely for an extended period of time, are there opportunities in, for example, Southeast Asian countries where there might be supply chains that are altered?
What we're looking at is places like Vietnam, places like Bangladesh, where a lot of the Chinese manufacturers are moving their production. So you have a very interesting situation where, okay, exports of low-cost goods from China to the U.S. are going down because of the tariffs, but that is being moved to these lower-cost countries. So that's where we would be looking to see opportunities for exporters, at least, in these weak currency countries. Then further afield, we're interested in places like Brazil because there's lots of reform going on there, and India. Those are the two countries where you're not going to be very much affected by what's happening in China and the U.S.-China trade disputes.
Okay. Now that's the global opinion. Let's shift focus to local. It's 8:45. That time of the show, we're going to be getting our technical experts on board. Sameet, Chavan, as well as Aditya, Agarwala, join in right now with their thoughts. Gentlemen, both of you, good morning. Thanks for joining in. Sameet, what's your sense? The penultimate expiry before the election D-Day comes in, how are you positioning yourself?
See, clearly for momentum traders, it has become, a nightmare trading such kind of wild swings. The kind of price action that we saw yesterday during the penultimate hour, it was clearly on unexpected lines. So yes, we came off quite sharply from the levels of 11,270, but still we believe that 11,130 to 11,070 is a cluster of strong support. So at this juncture, yes, I won't take aggressive bet, but if I have to, take any kind of bet in indices, I would rather go long. That too, I would avoid trading in futures, considering the overall volatility and wild swings. I would rather go long in 11,150 call option, which is trading around 34, 35. So I would wait for minor dip. So probably in first 15 minutes, if you get a minor dip and if this call option trades somewhere around 28.30, I would take that punt, keeping the entire premium as my risk, and I would expect a decent bounce back again. So around 11,250, 11,260, again Nifty comes back, then I would book out my profits. So at this juncture, 11,300 on the higher side, 11,100, 11,070. This is the trading range that we are expecting for index.
Okay, so Sameet's call is to go long on one of the call options that he recommended. Aditya, how are you trading the index?
So again, it's tough to trade the index at the moment, and it will gradually become even tougher as we approach 23rd of May. If you take a look at the volatility index, it's inching towards the 30 mark, and the moment it crosses 30 mark, we can expect the volatility index to test levels of 35 to about 36 also. It's been seen in the past that whenever election month, in the month of election, volatility index tends to test levels of 35, 36, and index tends to be a little wobbly. For the day, I'm looking at 11,200 as an immediate resistance on the upside. If the index manages to trade above that level of 11,200 for some time, probably one can take a long bet on the index for targets of 11,300. On the downside, 11,150 can be put as a stop. Again, on the downside, at the moment, 100 DMA is acting as a strong support for the index. So it's been back-to-back 3 trading sessions wherein we have taken support at the 100 DMA, which is around 11,120 to about 11,100 zone. So if index manages to break that decisively, then the next stop is immediately 200 DMA, which is in the zone of 11,000 to about 11,030.
Okay. But I think, as both of our experts stated, it's becoming very difficult for a momentum trader. I believe for almost any trader to trade this index. Yesterday was down in the last 1.5 hours. Day before yesterday was a surprise up move as well. So I think stop losses must be getting triggered at both ends in a meaningful way for a lot of average traders, actually for a lot of expert traders as well, because these are times that are almost virtually unprecedented of sorts, the kind of volatility that we're seeing on a daily basis and the swings on either direction. So do keep that at the back of your mind if you are indeed an index trader. Now, before we get to specific stocks from our experts, maybe we can get in Yash Upadhyay, because it's about time for our special segment Bloomberg Edge, wherein Yash joins in every morning or almost every morning and tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock or an index. Yash, what's the stock on your radar today?
So Neeraj, we're tracking Jubilant Life Sciences, and it's not a very liquid stock in terms of volumes, but the fear and greed indicator has given a negative crossover, and the hit rate too is quite supportive as compared to the other results that we got after running the criteria. But as always, let's first try and understand what the fear and greed indicator is and how do you interpret it. It basically calculates, it uses for its calculation the spread between the two weighted moving averages of the true range, and it oscillates on a zero basis line. A value in positive would make the fear and greed indicator turn its color from red to green, which indicates that one could go long from the current levels, and vice versa. When it comes to Jubilant Life Sciences, as I was mentioning, the fear and greed indicator has in fact suggested a sell signal on the counter, so has suggested a buy signal on the counter, and as you could see on the chart over here, the green bar over here that has formed after a series of red bars. There were a few green bars over here as well in the start of at the end of the month of April, but it was taken out again, and we saw the stock continue to fall further. But then again, we have seen another green bar forming, which indicates that the fear and greed indicator has flipped the momentum towards the side of the bulls. Also, we are taking a look at the longer term time frame. So this was as far as the daily chart is concerned. On the longer term time frame, in the weekly charts, what we've seen is that the RSI 2 has given a positive crossover. So we've drawn 3 circles as well as 2 lines along with it. Every time that we've seen that the stock has come down down to the level of 600, which has acted as a strong support. It has managed to bounce back from that level. The RSI too has found support somewhere around the mark of 38 to 40, and from there it manages to rebound. 600 is where it is at, 607 to be precise. And from the current levels, with the fear and greed indicator too suggesting a reversal, we could see a sharp pullback from here for Jubilant Life Sciences.
And how well has this worked in the past for Jubilant Life, Yash?
So Neeraj, 4 out of the last 8 times that the indicator has turned positive, the stock has managed to run up 4.5% to 5% over the next 1 month period.
Okay, interesting. Thanks a lot for that, Yash. So it's a 50-50 of when the indicator works. It tends to work very, very well. Do watch out to the fear and greed indicator. It's a proprietary Bloomberg indicator. Give an indication on Jubilant Life. Sameet, before we get to your stocks, any thoughts on Jubilant Life? The terminal indicates positivity, but there could be, because of the markets, there could be moves otherwise too. How do you look at these charts?
See, clearly it has been laggard since last, I guess, couple of months. It has already taken a nosedive from its highs of 870, 880. Now, hovering around 600. But, looking at the price action as well as the volume action, I don't see any encouraging sign as of now. So I would rather wait for some kind of follow-up move. And if follow-up move curve stocks, manages to break 620, which has been acting as a multiple resistance since last 3-4 days, and if volumes start picking in, then probably this stock could trigger some optimism in the near term.
Okay. So, conditional. Let's wait and watch what happens here. Let's talk about stocks that our experts believe that one can log on to. Aditya, let me start with you first. Your stock-specific recommendations for the day?
So I'm going in one long and one short because of the way the market's been moving. So UPL is a long trade stock on a continuous basis, has been making higher highs, higher lows, and in trade. Yesterday also we saw a good run up in the stock backed by volume. So at current levels of 970, I would go in for a long trade for targets of 1000. We'll place a stop somewhere around 960 to about 955. The second stop is a Hindustan Unilever. That's a short call. So if you clearly take a look at all the FMCG stocks, they've been losing their momentum, and HUL is one of them, which has been an underperformer. And on the daily charts, it's on the verge of a breakdown from a head and shoulders pattern. Head and shoulders is a bearish pattern. The neckline is somewhere around 1665. It's just there about on the verge of a breakdown. If it breaks down from that support of 1665, I'm looking at a downside target of 1635 to about 1615. We'll place a stop at 1690.
Okay. Sameet, what about your stock ideas?
See, since last couple of days, we've been tracking a mid-cap index. The kind of price action that we saw day before yesterday, it was quite encouraging. So we would rather focus more on mid-cap stocks, that have corrected in the recent past and have reached their major support levels. So BML, one stock that has fallen quite a lot in the recent past, tested its 200-day moving average, and day before yesterday we saw a bullish piercing pattern on daily chart. Yesterday, yes, we saw mild profit booking, but we would rather interpret this as a good buying opportunity. So if index has to surpass today 11,200, we would see a strong relief move in such kind of counters. So BML is a long from our end. 880 would be our target, stop loss 804. Apart from this, Just Dial, which has been clearly bucking the trend, it has managed to maintain its sturdy structure, and yesterday we saw a breakout happening from its resistance of 570. So we would go long in Just Dial as well, target at 600, stop loss 562.
Okay, now 2 or 3 key movers that one needs to watch out for. One of them is Zee Entertainment, and then the SL Group stocks. 2 days on a trot now, they've come off. Now, earlier in the week, I believe that the pullback could be because there was expectations that there'll be some bit of announcement over the weekend with regards to Dish TV. That didn't happen, and that's why maybe I thought Monday would have seen a pullback, but yesterday was yet another day when the stock cracked quite significantly, both Zee and Dish. So there is some issue out here with the SL Group stocks. Fundamentally, if you just look at pure play valuation, Zee is available at fantastic valuations. But there are some technical pressures right now at play, which a lot of people are finding it very difficult to understand as to why this could be happening. Remember, there's a big event which might well dominate what will happen to Zee Group stocks. But aside of that, there is some issue out here. Sameet, if I can come to you on Zee Entertainment or Dish TV. Difficult to make fundamental sense of this, so let me use charts. How do the charts look here?
See, among these two, I would certainly avoid Dish TV. We don't track this counter. Yes, but Zee, If you recall, during the month of Jan and February, we saw wild swings in this counter. Firstly, the stock corrected from the levels of 460 towards 300, and then we saw a V-shaped recovery back to 450, 460. Stock then went into consolidation mode, and again that selling has resumed in this counter. So what is important in this recent selling is it has come on the back of strong volume in cash segment. So that's not a good sign for this particular counter, and it has already breached its important support levels of 335, 340. So I would expect continuation of this downward move, wherein this stock can first head towards 300, and if it manages to break that, then we could see sub 300 levels as well.
Now, I urge you to remember that Sameet could well turn out to be proven wrong if indeed there is some announcement by the group with regards to almost anything from a deal to how close to a deal or otherwise. So keep that at the back of your mind when you're trading Zee. The other one or other set of stocks which are important are the global trade related stocks. So Tata Motors, Motherson Sumi and the likes. Big cracks in trade yesterday for all of those, including Tata Motors, which fell as if there was no tomorrow. 8.5% for Tata Motors in 1 month. It shaved off 30% of market cap. Motherson Sumi, Tata Motors, maybe a Bharat Forge, one of these which looks the most vulnerable.
So all three are going down drastically. Tata Motors, to say it saw a sharp surge from current levels of 170 to all the way to 240, and the charts look extremely bullish now. But again, it's turned bearish. If it manages to hold on to 167 levels, then probably we can see a pullback rally to levels of 190, 200. But it fails to hold on to 167. I'm not buying Tata Motors at all, because then I'm looking at a downside level of 150 to about 145 as far as Tata Motors is concerned. So the caveat being the stock should hold on to 167 levels for at least a couple of trading sessions, and it should show some signs of recovery. Then probably I can buy the stock, keeping a stop at 165 for targets of 190, 200. Coming to Motherson Sumi, stock is in a continuous downward trajectory. I would avoid the stock even trading at current levels of 117. Probably stock can slide to levels of 110 to about 102. 102 happens to be the major support for the stock, which is a decent about 10 to 15% lower from current levels. So Motherson Sumi would be an avoid as far as trading long is concerned.
Okay. Keep in mind, just a set of stocks, we are very close to market open. I'll just tell you though, Waterbase, the Q4 numbers were very, very wobbly. Margins collapsed, net profit down 42%, and this could well have an impact on Avanti Feeds as well. So the couple of names that you should monitor today, aside of the ones that we've already spoken about. So watch out for Waterbase, watch out for Avanti Feeds, watch out for, of course, the Tata Motors variety, watch out for Tata Global Beverages and Tata Chemicals. The swap ratio is in favor of Tata Global, and therefore that could either see a positive or Tata Chemicals could see a negative. And then the list of names which came out with good numbers include a Phoenix Mills, a Manappuram Finance and a Jammu and Kashmir Bank. So these are 2 or 3 names that you should keep at the back of your mind. The Asian screen, it's mixed bag again, as Shanghai was looking slightly more positive than what it is looking right now, but Nikkei was looking slightly more negative than what is looking right now. SGX Nifty has been ho-hum about 20 odd points, so don't quite know which way the markets will kickstart trade. The only question is, will we maintain the gains if we have them? Here are the first rates, all over the place as they usually are, so we'll give these rates a chance to settle down before we talk more about them. But I do want to just start off with what's happened to 3 or 4 usual suspects. So Tata Motors should first come up on your screen, Zee Entertainment should come up on your screen, Jet Airways should come up on your screen, and then Tata Global and Tata Chemical should come up on your screen. Tata Motors 2.5, Zee 2.5 in the green, but these rates will settle down, by the way, so let's not buy them completely. Tata Global Beverages, the swap ratio is in favor. Let's see if there is a 10% uptick. Tata Chemicals, the swap ratio is not in favor. Somehow that also starts off okay. Well, let's wait and watch what happens. Jet Airways has been on a severe downtrend the last few days, with reason, by the way, for now. I think these rates are very alright. Let's give them a chance to settle down before we talk more about them. But I must say, if Zee Entertainment starts off positively, it will provide some relief to a lot of people who had piled on to a trade which they hoped would turn out to be good. J&K Bank looks like reacting positively to its numbers. I don't know if there'll be a 15-16% uptick or no, or a 10% uptick as well, but at least the numbers optically seem pretty interesting. Let's wait and watch. Kesoram was the other set of numbers that seemed interesting. Let's see what the reaction is. KRBL let's wait and watch, really. I would wait for all of these numbers and these rates to settle down before we talk more about them. Mahindra Holidays seems to be starting off on a slightly negative note as well. The numbers weren't the most positive, and maybe Mahindra Holidays too could have a start which is in the red. Pidilite, 3% lower again, 1130. The domestic volume growth was very poor. Maybe the stock, this was of course day before yesterday. Yesterday the stock bounced back quite smartly. Let's wait and watch in today's session whether it stays in the red or whether it bounces back yet again. So 3 or 4 names to monitor. The currency and the bond yield should come up. The flows are negative. The trade deficit numbers weren't the most optimistic. The currency is not showing too many signs of a wobble there, 70.27. The bond yield should come up on your screen as well. Let's see if they are okay, 7.39. So again, just at those levels, we hardly see any big movement. On a day, they could move up to 7.46, then could correct a bit as well. But usually around these levels is where the yields seem to have settled too. So no big negative or positive reactions out there on the bond yields as well. As I said, the trade deficit numbers looked weak. Yeah, the numbers widened, but most people that I spoke to, I was speaking to Ira as well yesterday, the thought process seems to be that it's very difficult to place a lid on or place a handle on whether or not these are trending numbers when it comes to exports or otherwise. So let's wait and watch. We'll talk to DK Joshi about this a bit later on. It'll be important to monitor that conversation as well. But speaking of stocks which are doing well, J&K Bank does look like in the first 3 minutes that it'll start off on a slightly positive note. Aditya, any thoughts here? Jammu and Kashmir Bank?
So one issue with the stock is the volumes are a little on the lower side. Having said that, stock did see a good run up from 40 to about 65, and from there it's clawed back to 50 levels. If the stock manages to trade above 57, which is showing on the screen right now, so if it manages to trade above 57, I can take a long trade. We'll put a stop somewhere around 52 and look for a northward target of 62 to about 66.
Okay, so J&K Bank, watch out for that. I want to also get a view on the third set of names which were very active the last 2 days, which were the pharma companies. Now, Sameet, after Sun did what it did day before yesterday, yesterday was a relatively calm day. What do you do with Sun Pharma or any of the other large cap pharma names which are very active?
See, Neeraj, honestly speaking, the kind of volatility that we are seeing in Sun Pharma, it is very rare to see in such kind of counters. 3 days back we had a sharp cut and then again a recovery towards its important levels. So 420 is the level to watch out for. If the stock manages to surpass, stay beyond this, then it can head towards its next resistance zone of 440, and on the low side 400 seems to be an immediate support level. So 400 to 420 is the immediate range. Any breakout on either direction, we would see a good trending move in this counter.
Okay. Well, the other big monitorable, of course, is what's happening to crude. Remember, the OPEC meet lined up, and ahead of that, I think the crude prices have moved up. The spread between Brent and WTI crude futures has also widened quite a bit. The supply side constraints from Iran and the recent attack on oil pipelines in Saudi Arabia have pushed crude prices higher. It comes, as I said, ahead of the OPEC and the allies meeting in Jeddah tomorrow. Daniel Haynes of ANZ believes that while supply from the US has increased, Saudi Arabia is happy to let prices rise at the cost of losing market share. Listen in.
The issues around heavy crude, coming out of the Middle East, has its challenges. Obviously, Iran at the moment is the key issue, and then also out of Venezuela, we've got obviously the US sanctions on that country. So, that market is extremely tight. But obviously, on the flip side, we're seeing, still some positive growth in output from the US. I mean, certainly that growth has eased a little bit of late, but overall the dynamics are completely different to what we're seeing in the Brent market. So it's not surprising to see that spread really widen. And to be honest, it feels and looks like that's going to be a continuing trend for the foreseeable future.
Yeah, and another wild card there. We've got OPEC noting that about $390 billion, extraordinary amount of money, being spent on bringing on new supplies in these non-OPEC countries following the recovery of the crude prices. This really undermines OPEC's whole plan, doesn't it?
It does. I mean, although they've been pretty happy to play that price-driven strategy against that volume one that we saw a few years ago. And I think when you look at clearly Saudi Arabia's economy, it's actually benefited. I think they've done relatively well out of that switch. So I still think that's something that they're going to keep in mind when they come up to their OPEC meeting. Clearly, the tightening sanctions on Iran will be an issue, and I think they'll have to take that into consideration. But I think they're happy to see prices inch higher but lose market share at the same time for the moment. I mean, there'll be a tipping point, but certainly for the moment it feels like they're happy to see that continue.
Daniel, not surprising, we saw a spike in volatility when it comes to oil. This GTV chart on the Bloomberg showing that spike that we saw recently. Of course, we have so many conflicting forces, including that geopolitical tensions in the Persian Gulf, supply disruptions, trade conflict, also increasing U.S. supplies. So in the long term, which of these forces will win out?
Yeah, no, it's certainly making my job a lot more difficult. I think, though, when you step back from the market and these short-term issues, clearly the US supply growth is something which the market is going to have to deal with over the medium to longer term. At the moment, as I said, that growth has certainly abated somewhat, and that's partly due to some of the bottlenecks we're seeing. But the ongoing growth we expect to see rebound relatively strongly at the end of this year and into 2020. So, that's going to be something which weighs on the market for some time to come. And, I think certainly investors have one eye on that, despite, the ongoing supply side issues that we're seeing right now.
Well, the interesting bit would be that if indeed crude continues to move higher, what happens to some of these oil sensitives? Sameet, if I can come in to you, and what would you do with maybe BPHP, RC or some of the others?
See, as far as BPCL is concerned, it has now stuck in a range. It has been trading in the boundaries of 390 on the higher side, 340 on the lower side, and is now trading around its midpoint. So in case if the stock gives further decline towards its lower end, which is around 340, there's a cluster of support. 200-day moving average placed around 340. There are previous breakout from where this rally started, coinciding with that 335, 340 kind of zone. So I would avoid when this particular stock trades around the midpoint of the range. At the decline towards 340, I would be more comfortable considering the overall risk to reward ratio.
Okay, they've gone out of favor, I must say, the oil marketing companies from a trade perspective, so keep that at the back of your mind. But the pre-open rates have settled, and as they have settled, I just want to mark out 2 or 3 names because it's a lot easier to mark stocks now. Tata Motors looks like starting off in the green, so after 2-3 days or after a month of severe cuts, Tata Motors is looking like bouncing back. Whether it will stay at those levels or not remains to be seen, but it looks like it'll start off well. What looks like not starting off well, actually precious little level to the broader in the spectrum. Petronet LNG might have a cut, which is down about 2.5%. And remember, the numbers weren't the best. For people who are tuning in right now, watch out for Petronet LNG. The revenues were down about 17%. Margins came in at 7.5% versus 8.4%. And other income was up 71%, as a result of which the numbers optically look padded up. But it was a weak quarter, so keep that at the back of your mind. And I must point out to one more stock before we talk about all that you need to know, and that is Aditya Birla Fashion. The reason I bring this up is because people who may not know and would not have seen the closing hours of trade yesterday, AB Fashion cracked. It dropped like a rock, and a heavy one at that, in the last 5 minutes of trade. So almost a 10% downtick in trade yesterday, more so in the die moments of trade, and starts off another 2.5% weaker. The numbers left a bit to be desired, so keep this stock at the back of your mind as well. For minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. First up, in Nifty earnings today, Bajaj Finance, Bajaj Finserv and Hindalco will report their fourth quarter numbers. In earnings which came yesterday, Manappuram Finance, Phoenix Mills, Jammu and Kashmir Bank and Magma FinCorp reported a strong set of numbers, while Petronet LNG, Majesco and Mahindra Holidays reported a weak set of numbers. On the other hand, Torrent Power, Gulf Oil Lubricants and SKF India reported the numbers that just about met estimates. The Tatas will consolidate their food and beverage business under one roof. Tata Chemicals will demerge its food business to Tata Global Beverages. The swap ratio is in favor of Tata Global's shareholders. And in key brokerage calls, CLSA has cut Motherson Sumi's price target to 135 rupees, citing weak global auto commentary. However, it has maintained its outperform rating. Now, just before I get in some top calls, I just want to revisit the first discussion that we had on IndianOpen today, and that was Tata Global Beverages and Tata Chemicals. For the uninitiated, there is a deal that has happened wherein Tata Chemicals transfers its food business into Tata Global Beverages. The swap ratio is in favor of Tata Global, as a result of which you've seen this 4% uptick on Tata Global Beverages. I want to mark Tata Chemicals as well and see what that stock is doing in the session today. It's not starting off weak. The expectation was that even that could happen, that Tata Chemicals could start off weak, but that hasn't happened. Just that Tata Global Beverages is starting off on a good note. Aditya, it usually flatters to deceive Tata Global Beverages. A 3% up move. Can we see a follow through here? Is it possible to predict that?
So I'll tell you something, and whenever Tata Global Beverages gives a breakout, it's a false breakout, it tends to claw back, and I've seen it over time and again that Tata Global fails to give you a proper breakout. But following this news, if the stock manages to trade above 207 to about 210 zone, that is the immediate resistance for the stock, probably one can take a punt, a long punt in the stock for targets of 220, and if 220 is taken out, which is a major hurdle, stock can test levels of 225. On the downside, 190 should be a good stop.
Okay, and I think that's a pertinent point because it's managed to give false breakouts a number of times. This time there is a fundamental reason, but let's wait and watch. There's also equity dilution that you've got to keep in mind. The other one, and the set of numbers, and just 2 or 3 names that have reacted marginally to the numbers. Sameet, any one of these names, Kesoram Industries, KRBL, and a company that came out in numbers 2 days ago, Snowman Logistics, up about 2.5%. Any one of these that you track?
No, I won't be able to give any kind of trade setup, and yes, this is just a reaction to the numbers, but I would rather wait for some kind of follow-up moves.
Anyway, Sameet, very quickly. Okay, I think we've just missed that. We'll take that call after market opens because we are very close to market open, but the stock that I wanted to ask Sameet Chavan about was Jet Airways. It looks like starting off on a positive note. After a number of days of a fall, Jet Airways might just start off marginally higher. Let's wait and watch what happens there. But about a minute left for the markets to kickstart trade. So it's important to get in the top trading call from our experts. We've discussed a number of stocks already, but if you had to nail it down to one stock, gentlemen, what would that stock be? Aditya, let me start with you first. Your top call for the day today.
It has to be UPL for a target of 1,000 rupees, put a stop at 955.
United Phosphorus, a target of 1,000, a stop of 955, which would mean that UPL will be at life highs if it does manage to do that and will cross the 50,000 crore market cap number. Sameet Chavan, your top call for the day today.
Target would be 880, can be bought with a stop loss of 804.
Sameet, I missed the stock.
It's BEML.
Okay, it's a BEML and you're going long on that one?
Yes, I would expect a target of 880 and stop loss would be around 804.
880 and a target of 804. Okay, gentlemen, just stay on. We'll take in opening thoughts from you before we let you go. The markets look like starting off marginally positively. The question mark only is, will they last that flavor? Well, we'll get to know about that moments from now. For now, starting off well, 0.25%, well in context of what the rest of the Asian markets are doing, which is a bit of a mixed bag. The Nifty Bank though has quickly slipped into the red as well. So bobbing between the red and the green, a bit of a flattish start. What are the mid caps and the small caps doing? Well, a flattish start for both those indices as well. So not too much really between the mid caps and the small caps to choose from as well. Maybe get the heat map and talk about the stocks since the indices don't seem to be doing too much or precious little really. Oil marketing companies marginally off. Today there's an absence of losers because you can see the crude price reactions dominating the trade on the downside. So not too many stocks falling. What about the gainers? Well, some interesting moves. Tata Motors bounces back after a number of days. Yes, Bank has some gains, which is good to know for their shareholders. Infosys marginally higher. Vedanta and JSW Steel marginally higher, as is Hindalco. Actually, commodities and not had a bad start. It's not big bang moves, but JSW, Tata Steel, Vedanta, Hindalco, all of them start off positively. So the entire top row is dominated by what's happening to commodities. To an extent, Hero MotoCorp has done okay, about 1% higher, but no big moves. Reliance is 0.5% higher. Can't even see the HDFC Twins anywhere, so they must be lying absolutely flat. Right here, HDFC Bank absolutely flat. So no big moves. Tata Motors is the big one. On the losing side, it's all marketing companies, but you have to say that the first 1 minute belongs to Tata Motors. After days and days of a pullback, that stock has started off reasonably well. What about some of the others? Some key trend makers, some result reactions that I want to point out, and some stocks in news too. So firstly, the stocks in news, Tata Global Beverages and Tata Chemical. Tata Global at least starts off positively, 3.5%. Let's wait and watch if there's some more uptick to this boy in the session today. What else? Stocks that came out with good numbers. Let's see what's happened there. Magma, small reaction. J&K Bank is the big reaction. And Manappuram, interestingly, optically it looked a good quarter, but stock started off weak. However, J&K Bank is starting off on a positive note. What about the weaker hands? The companies that came out with a slightly weak quarter, and all three reacting negatively. So Petronet LNG, duly so, 3.5%. Maybe the next quarter is good. Maybe the July, August, September quarter is good because of the current spreads, etc., between Brent and Singapore GRMs. But for now, weak quarter. Majesco, flattish. But Mahindra Holidays, yet another quarter of pain, and the stock is about 3.5% lower. Somehow, yet another company which has shown a lot of promise in the past, but not quite being able to deliver on that. However, the big boy, as I said, has to be Tata Motors. Now, we discussed OMCs just moments from now. If we want to look at some other stocks, Sameet, Chavan, I want to come to you on Tata Motors. 3.5% higher. Is there a bounce back trade that you can play on Tamo?
See, honestly speaking, Neeraj, we have been closely tracking this counter, and considering the fact that the stock reached its March lows of 167, there could have been trade if the stock would have opened flat or slightly sluggish to somewhere around 167, 168. Then the risk reward would be quite favorable, but not at current level. It has already bounced back. So some kind of follow-up move towards 182 is quite possible. But if the stock has to give any kind of trade reversal, it has to first surpass and sustain beyond yesterday's high. That is around 185, 186.
Okay. Amongst the stocks that are losing out, and remember Aditya Birla Fashion is cracking yet again, so another 3% gone. But the top loser is Central Bank of India, and PSU banks, after having a ho-hum day yesterday, look like starting off slightly wobbly. Dish TV is the other one, by the way, which is down about 3%, so keep that at the back of your mind. But Aditya, Central Bank of India, 7% lower.
So it managed to take hold on to its 27.5 to about 28 support for a long time, and trade it's already broken that, and volumes are high in this breakout in the early trading sessions. I believe the stock can test its immediate support, next immediate support of 22 at current levels of 26. There's a decent 4 rupee downside.
Another 4 rupee downside that could come about on Central Bank. You'll be comfortable initiating a short here.
Yes.
Okay. So, and if you, of course, have that stock in your portfolio, please get out of it. Aditya, take a moment to thank you for joining in today and giving your thoughts. Appreciate your time. That's Aditya Agarwala. And speaking of Central Bank of India, Sameet, before we thank you, 2 stocks, choose either of these. One is Dish TV, which is looked very, very wobbly. Can it do further damage to itself? Or alternatively, a Lupin, which has started off about 3% lower.
See, as far as Dish TV is concerned, we generally avoid this counter, but the overall setup is clearly weak, and from here on, you won't be surprised to see this stock heading towards 25, 24, 23 levels.
Okay, and any thoughts on Lupin?
See, it has been laggard since last couple of weeks. It has already corrected quite a lot. So 750, 745, these are the levels to watch out for. It's a strong support zone. If it manages to hold, then at least we could see some kind of respite in this counter.
Okay, we'll leave it at that. Sameet, Chavan, thanks much for taking the time out and joining us today and giving us that perspective.
Thank you.
Well, the markets are absolutely flat. Just nothing happening out there. But it's always good to get an expert opinion on what the sentiment around is and what the markets could do, not necessarily in the near term, but maybe once this election madness is over. An important market voice, Aashish Somaiyaa, Managing Director and CEO at Motilal Oswal Asset Management, joins us right now in our studios. Aashish, so good having you. Thanks much for taking the time out.
Thank you.
How difficult is it right now to tell all your subscribers or all your clients and meetings that you address about what the markets could do in the near term? Because frankly, almost every single day, we're seeing volatility which is very high, but the levels not moving around too much.
I think if you're part of the markets, I mean, I'm going to share something with you which is not necessarily directly to do with the stock market itself. But what I've realized is that there are times when, things are really bullish. And when things are really bullish, everybody thinks in very, very macro generalistic terms. At that time, I find it important to bring our clients to the details. And there are times like this when people lose sight of the big picture, they lose sight of the macro, they lose sight of the general long term, and they get overly focused on the micro. So I think this is more a question of perspective. When things are looking, I'll give you an example. Now you look at what is happening with auto. When things are booming, everybody says that, the auto story actually starts with $4,000 per capita. We have a long way to go. And there are times like this when people say that, if you add up all the two-wheelers and all the four-wheelers, and if you add up the number of people who can afford them and the number of families, I think we're pretty much penetrated. I mean, what is left? So I think this is a question of keeping the right perspective and not getting overly focused on here and now. That's the point.
So if you are not overly focused on the here and now, but looking at the long picture, which is largely higher, what is it that you have been doing in your schemes? I also want to talk about, by the way, a couple of new launches or a spate of new launches that you're planning to do. You were pretty active on Twitter about it. I would want to talk about it. But first, within your existing portfolios, Aashish, where has been the bent of the large spate of asset managers that you have? What is it that they're trying to do within the schemes? Where is it that they're going overweight? Where is it that they're going underweight?
No, I think when it comes to us, I mean, frankly speaking, if you ask me in the last 6 to 9 months, the kind of deep slowdown that you're seeing with auto, I mean, we don't have exposure to, say, FMCGs and consumer, really speaking. Never had that much exposure, really, in the last couple of years. But if I speak about the auto part of it, then yes, there are a couple of exposures in the auto segment, and the kind of, deep cut that has come in has definitely taken not only us, but taken a lot of people by surprise. Now, our understanding is that this is not structural. So we are definitely going to live through this, and we are pretty sure that eventually investors also will make good out of it. I mean, there's no harm in living through this near term. It's just that when there are some cyclical headwinds, like, very long-drawn election season, and of course we know what is happening with lending and NBFCs and stuff, the general business environment, level of confidence has been slipping in the last few months. So I think those are cyclical in nature, and my senses will be out of it. So we are living through that. But as far as the other sectors are concerned, I think, if you see at our end, there are not many dramatic shifts in the sectoral exposures. Okay. So if you see private sector banks, I mean, one thing where we are way away from the index is, for example, we've had high exposure to insurance for quite some time now. And that still stays, no change out there. So private sector banks, we never had very large exposure to NBFC, barring a couple of them. So that still stays as it is. So honestly, not many big changes.
You haven't gone out and made radical changes to your portfolio because of what's happened in the market in the near term?
Yeah, because our belief is, I mean, that's not our style, really, if you ask me. To react to, near-term developments is not what we do. There are times when we think that, okay, companies will, even the best of companies will go through a couple of bad quarters. I think we have to convince ourselves that their franchise is intact. And if the cyclical parameters are behind us, then will they get back to their winning ways or not? I mean, that's a true test of the franchise being intact. So as long as we are convinced, we are not going to react to what happens in a quarter or two.
Interesting. Let's speak about some of these pockets. Now, insurance, we just filed a story, I think, or we're putting out the story today about how the AP growth for a large slate of insurance companies has been the highest in the last 22 quarters or something like that, 22 months or 22 quarters or something like that. Now, there's a constant debate about whether this industry is under-penetrated or over-penetrated, because a lot of people cite the number of houses which already have insurance. And because of the low per capita, how many of the other ones which do not have penetration will anyways think about taking insurance as well in the first place? Where are you guys on this argument? And or is the call on insurance not a factor of penetration but of some other reasons?
So there are multiple things. If you ask me, one is, on the first point on penetration, I mean, I find it hard to believe that we are right up there kind of thing, because a lot of times people say these things in terms of the number of people who are eligible to take a policy versus how many number of policies are out there. Yeah, I think that's the often quoted number. But the fact is that, you ask somebody what level of insurance they own. what's the materiality or what's the calculation behind the insurance that they're taking. And my guess is, unfortunately, India is a country where people buy insurance to save tax, and they're not buying it for the core purpose, right? So I think that is a measure of underpenetration where people are underinsured, and people don't have a sense of how much they actually need. So that is one thing. Second part is that, if you think that so many, the loan growth, let's say, mortgages, consumer loans, car loans. So how can it be that consistently keeps rising, but people don't feel the need to actually increase their insurance? Also, how many people, even people like you and me, our friends, if you were to actually calculate, then how much do you earn and what is your level of insurance? I find my own friends are underinsured. So I think the awareness is pretty much not there, and that is because people buy insurance to save tax, not for any other reason. Coming to the second point, I think that insurance companies are, their business kind of seasons over a number of years, right? And we have to keep an eye on how the EV is actually progressing over the number of years, what kind of track record they have, etc. The other important thing to keep in mind is that insurance is a business where brand matters most. Otherwise, how do you explain it that for the same policy, for the same cover, there are companies with some 40% kind of higher premium?
Sure.
Right? So there are multiple, it doesn't get evaluated with these traditional valuation parameters. I think there are multiple drivers to it. Also, what I should keep in mind is that people like us, whatever I say, take it with a pinch of salt, because that we hold stocks for 4 or 5 years irrespective of even if our couple of quarters performance goes bad, we still stick it out and we hold on. But a lot of people in the market have a 1 quarter forward or a 1 year forward perspective. So I think that needs to be kept in mind.
Okay, pertinent points. The other conversation, aside of course, autos and insurance, which you must be owning, is what's happening to select pockets which look like turning around. Now, I've heard from a lot of your peers in the asset management industry about how Telecom now seems to be looking ripe for a bit of a pullback. Do you guys have any view there? Do you personally have any view about what could happen to Telecom?
So first is that it's unlike us to fish in troubled waters.
Okay.
So it doesn't suit our way of working. For example, the first time we took exposure to corporate sector banks was after some of these governance issues were behind, and we could see that there are early signs of improvement. So we don't mind losing the first 10-15% or even the first 20%, and we don't mind entering after we can see that there is a runway out there, right? So we are actually not the kind of guys who would fish in troubled waters. That's the limited point, I will say. And from that perspective, I think we have a lot to see. The other is we'll not get into businesses which very, very high leverage, right? Because a couple of bad quarters and everything can just, all the rosiness can just evaporate. So I would just leave it at that. I would say it's not our style. But I think people who do believe that there is deep value out there, maybe they might want to take a plunge.
Okay.
That I don't disagree with, actually, if you ask me.
Yeah, I mean, it's a different style for different people, and I think whatever suits whoever is the kind of call that they will make. Aashish, what's the view that you have on the stocks that get impacted from a global trade perspective? Now, we've seen different treatment meted out to different companies. The more defensive bent information technology has rather held out well amidst this whole US-China trade spat, though it probably doesn't get impacted that directly.
Yeah.
But autos, for example, Tata Motors, Motherson Sumi, and their whole pack has literally gotten butchered in the last 1 month.
Yeah.
What happens next? Because this doesn't seem like ending with Trump's recent move on Huawei. It doesn't seem like they want to scale it down immediately.
I think that there is escalation, and there is, brinksmanship or one-upmanship which is at play out there. The unfortunate part is that, for example, during our younger days, we all have seen these WTO negotiations and so many things we've been through. I think the difference was there at that time there was no social media and there was no communication actually which came out. And now I think the challenge is that while pretty much what might have been happening 15-20 years back, maybe this is exactly what was happening back then also. But I think now the level of information is so high that literally every part of the negotiation is being put out in public. So I think that that causes more turbulence according to me. But apart from that, I think it's too early to make a call on this. I mean, fortunately or unfortunately, whichever way you see, we don't have any of those exposures in our portfolios. But I think these are things which will take 3, 4, 5 years to really play out. Because, there is a realignment of supply chains. Clearly, for some companies, there will be a deep psychological impact of how it plays out for you when you operate in certain jurisdictions or certain geographies. right? So I think for them, these are very, very big changes. And I think it will take 3, 4, 5. I don't think that people should just jump in because they think that there is some realignment happening. We don't know the final shape of these things to come. So it's best to stay out of anything which you think is remotely in the eye of the storm.
Okay.
And no early conclusions to be made, honestly.
No early conclusions. Okay. One final question, Aashish, before we let you go. This whole spate of challenges that have cropped in the NBFC space, you reckon they'll die down soon? I mean, is liquidity the primary concern? And if that suffices, will we see sanity prevail soon?
I think I used to really think a couple of months back that, and I was wrong at that time, it looks like. I used to think a couple of months back that, the worst is kind of behind us. But, you are again seeing these issues cropping up. And my fear is that what started as a liquidity issue, when something, in this whole thing, it always starts as a liquidity issue and then it boils down and then it kind of spreads further into credit and other solvency related challenges. So my sense is that a lot of damage has been done, unfortunately, right? And the powers that be need to really kind of look at this, once this election is out of the way, at least there is a perception that, we need the election to be out of the way and then we need somebody to really roll up the sleeves and look at the situation. So I just hope that it's handled well and it doesn't blow out into something big. But my fear is that yes, there is some damage which has been done and people are really fearful of the segment.
Well, maybe again, troubled waters might help not to go out and fish unless you know the waters very, very well. But Aashish, Somaiyaa, take a moment to thank you for joining in today.
Thank you
on
for
such
having
short
me.
notice. Really appreciate.
Thank you for having me.
Yeah, pleasure. Pleasure is entirely ours. Take a break on that note. Coming up, we try and decode earnings. Fourth quarter numbers of KPIT Technologies. Kishor Patil joins up immediately. And even amongst the consumption slowdown, India's trade deficit widens in April. We talk to DK Joshi of CRISIL about the same.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint. Better?
Same.
Now? Abhi?
I think so.
Sometimes we can't see what's right in front of us. And when it's clear, then the big picture becomes fuzzy.
Perfect.
The right lens always is.
back to the Indian Open right here on Bloomberg Quint. The markets are holding out reasonably okay, about 1/4% in the green for the Nifty at least. KPIT Tech came out with numbers not strictly comparable because they demerged their engineering division and given it off, hyped it off as well. So there is, keep that at the back of your mind. But the company, just about 3 weeks ago, post this was done, after the 3-step deal with Birlasoft, the newly demerged company has come out with its earnings for the first time since listing. In a chat with us at the time of the listing, the management had guided for an 18 to 20% growth in the next couple of years. Is the company on track to achieve this target? Let's ask co-founder, MD and CEO, Mr. Kishor Patil, who joins us right now on the show. Mr. Patil, good having you. Thanks so much for joining in. The reported numbers are thus: the revenues at 501 crores, net profit at 30 crores, and margins at about 12.3%. Now, since I can't compare these with any comparables, can you make an apples to apples comparison of how the quarter was?
Absolutely. We are first very happy to report the first quarter post our demerger. The year end really ended on a very good note for us, as we have mentioned. Overall, our revenues on year on comparable basis grew by 25% overall, and in the services business, which engineering services business, 30%. So, which is very satisfying and probably the best in the industry. So from that perspective, and on the year-on-year basis, this revenue growth on the comparable basis would be again more than 14%. So I think that's a reasonable performance, and the quarter performance was in line with what we have mentioned last time.
Okay. So in light of that, can we now talk about how do you think the next year is shaping up? When I look at what brokerages make of your new company or the company as it stands right now, everybody says that software is eating the automobile and KPIT is playing into that. That's one of the comments that came in as well. Can you talk about how is the business looking for the current quarter, and how do you expect the year to shape up to be?
Absolutely. I think I want to go back a little bit and talk about last year so that it creates a ground for this year. I think apart from just the number growth, I think what was very satisfying was we executed on our strategy. And our strategy was really to focus on fewer customers, we call T25, top 25 customers, and really have the growth. And more than 80% of the growth has come from these customers. We really focused on the new technologies which are shaping the automotive market. So whether it is electrification, autonomous, etc. And the growth has come in from all the three regions, which is whether it is US, Europe, and Asia. So that has been very satisfying. I think going into the next year, we believe that we are looking at the same to form the growth. We believe that we will continue to grow from our 25 customers. The areas of growth will be the same, whether it is electrification, autonomous, connectivity, and some standardization. So I think this is what will drive the growth. We believe that the growth will be led by Europe and Asia for the next year. Also, US will grow, but I'm just saying this will be forefront for. That's what we believe. At the same time, the industry is going through a lot of changes, automotive, and as you might have seen, that there has been major layoffs by major large automotive company. The volume of sales of car have come down. However, the profitability has gone down. But one of the major reasons for this is basically technology disruption and where we play exactly. And so we are reasonably confident, bullish about what we are doing and continuing growth momentum. And that's the reason we have mentioned that we, in next 3 to 4 years, we will become a $500 million company. That's how the outlook we have given. And for the next year, we have said that we will be between 16 to 18% outlook for the growth and expansions of margin from where we are today. to 14 to 15%. Now, looking at this automotive state of the industry, that's what we have. We have been cautiously looking. It warrants a cautious approach, and that's why we have talked about 16 to 18% for this year. At the same time, we have talked about 3 to 4 years outlook for about $500 million revenue.
So am I understanding this correctly, that if indeed the automotive volatility in the globe becomes a lot more linear and predictable, then your growth numbers could be higher than the 16 to 18% that you've put out?
I mean, at this point of time, we believe we feel confident about 16 to 18%. And as the years pan out, we will see what additional opportunities come our way.
Okay. The margin question was going to be the next one. This 12%, 12.5% seems to be a threshold because you're already talking about reaching about 15% in the next year itself. What happens in the times to come? Because I reckon smaller companies need to get foot in the door. By smaller, I mean on a relative basis. Get a foot in the door with some of your large clients that may come at the expense of pricing and eventually improve margins in a meaningful way. Would that be a trajectory for you as a company over the course of the next 3-4 years as you reach that $500 million guidance that you spoke about?
No, I think KPIT has invested into automotive business for a long time. We have been one of the pioneers for that, 15 years plus investment in this industry. And we, in some way, were expecting some of this trend to become more prominent, and we had invested ahead of time. So we believe these, specifically in the new areas, there are very few companies who can really contribute meaningful to some of these production level programs for the automotive industry, and KPIT is certainly one of them, or one of the leading companies of that. So we do not enter into an account or with any lower margins or lower rates. So I think not only that, we believe that we have to create we have to be net talent generator because we are one of the leading companies in this space. So from that perspective, to attract some of the best talents, we need to invest. So from that perspective, that is not our strategy. Our strategy is to really go with a strong positioning and ensure that we deliver on this complex program. So that is our strategy. And I think the margin expansion will be driven major by growth as well as operational efficiencies.
Let me rephrase myself. So
sure.
On the provider focused on mobility, you would be the largest pure play engineering services provider, and which I don't think anybody has a doubt of. My question was more, Mr. Patil, that would you look to, in a bid to enhance your revenue base, look to sacrifice margins in any way? And if not, what is the average near normal margins that you would clock in over an average for the next 3 or 4 years as you look to reach the targets that you've laid for yourself over the next 3 or 4 years?
Sure. So we have looked at, we have mentioned that our outlook is in next 3 years, we will achieve somewhere between 16 to 18% margin. So that's what we have mentioned. I think, we have been investing into technologies and global centers. In Europe region, we have more than double the headcount last year. So some of those investments we are making, and those will get leveraged, and that's how the margin expansion will also happen.
Okay. What about client wins? Mr. Patil, if you can give some color. You've already spoken about how some of the largest companies would be your clients. What's the average size of deal wins that you've had in the last quarter? Does that ratchet up meaningfully over the course of the next few quarters?
Absolutely. I think our pipeline is pretty strong. We don't talk about exact numbers, but let me tell you that our pipeline is pretty strong. And I think we continue to win significant deals, meaningful deals with these customers. So our focus is really on these T25 customers, we have the highest wallet share for these customers. And I would say that majority of them we are already, and now we are riding on the additional technical investments they are making and taking the higher part of that share. So we will continue to do that.
Final question. Nobody seems to be able to put a finger on how worse can it get as far as the trade war goes before it gets better, if it does. In light of that, is there a possibility that your current assumptions for 16 to 18% might be revised downwards if indeed the trade war worsens, if there are auto tariffs, and therefore the growth for the automotive industry by and large comes off meaningfully from where you estimate it to be right now?
I think that's why I talked about certain uncertainties into automotive industry. But what we have seen is, there are uncertainties because there is a certain kind of uncertainties between UK and Europe, between US and Europe, US and China. So there are multiple plays. I think one important part we have done, that's what I mentioned, probably as compared to any other company, we have very balanced revenues across the region. And in all the three regions, we have establishing centers which allow us to tap into the local talent and service them there. So I won't say there won't be any impact because, but as I said, most of these automotive companies are very clearly aware that if they do not invest into new technologies, not only they are losing market share today, but their revenues will go down in future. So most of them are not compromising on this technology investment. They are trying to rationalize them through collaborations and mainly regionally. So I personally think that this may have some impact, but it won't be as pronounced impact.
Okay, we'll leave it at that. Mr. Patil, thank you so much for taking the time out and all the best for the quarters ahead.
Thank you very much.
A very confident management, despite the automotive slowdown, saying that 16 to 18% could be a growth, which I don't think too many people will scoff at in the current scenario. They believe margins could improve from this 12.3% they clocked in Q4 to almost 15% at the end of the next 4 quarters. So pretty strong guidance. Let's wait and watch if that happens. Well, one thing that will not hurt them because they are so globally exposed is India's own problems, because India certainly seems to be having some issues when it comes to trade and growth. The trade deficit widened to a 5-month high in April. But there could be 2 reasons behind this: expensive oil imports and slower exports growth. But overall, crude consumption may have fallen in the last month as the economy turned lethargic. While oil prices remain susceptible to trade war and slowing global growth, can India do enough to spur exports? That's the key question. And let's ask that to Chief Economist at CRISIL, Mr. D.K. Joshi, joins us right now on the show. Mr. Joshi, good having you. Neeraj here. Good morning. I wonder, though, if people should make too much out of these numbers because the last data that had come out before the one that came out yesterday, people were a lot more sanguine about the export growth. Suddenly, there seems to have been a bit of a spanner in the works, maybe because of what's happening around the world, and that may well change in the time to come. How have you read into the data?
Well, I think I agree that I think 1 month data is not enough to look at, to assess the trend. But what is also happening is that probably there could be some front loading of exports in March, and I think petering off in April because of GSP, expectation of GSP, etc. So, but overall, I think if you look at exports, exports haven't done too well in the last 4 or 5 years. Which is despite global economy picking up in 2017, our exports were still not doing that well, and I think that's largely because of domestic issues, which particularly related to refunds and liquidity, which did not allow exporters to take advantage. So I think from here on, you mentioned about the trade wars. I think trade wars do pose a risk in the short run because they reduce the growth rate further in the advanced countries, and which is anyway going down. So I think the demand probably weakens as a result of that. It creates uncertainty, and in an uncertain environment, investments and trade do get hurt. So clearly, I think expanding your exports in this environment will be like swimming against the tide. And then I think if I add to that, there are competitiveness issues. We have been losing market share in labor-intensive segments to more nimble economies like Vietnam and Bangladesh, etc. So I think going ahead in the short run, definitely there are challenges, but there could be another opportunity coming out of this trade war, which is because of the trade wars, there could be trade diversion, and India some of the production units could be planning to move out of China, diversify into other economies, and India would be in the radar of the economies where it could be moved. So I think if we make our policies more conducive, then we might get more. But I think in the short run, there is, I think, I would see pain as far as the trade is concerned.
How do you read the non-oil, non-gold imports, which are weakening for the last 6 months, reflecting weakness in domestic demand? And could that continue if indeed the economy continues to remain sluggish?
Absolutely. I mean, I think that's a reflection of the weakness in consumption demand. Also, I think to some extent investment demand, and economy is slowing. I think the GDP data implicitly showed that that the economy would in the fourth quarter would be expanding at around 6.5%, which is much below the trend rate of growth of India. So clearly, I think there are domestic demand issues, and they are also getting reflected to some extent in lower imports of non-oil, non-gold. I mean, so it's perfectly in sync with what's happening in the domestic economy.
Okay, aside of that, Mr. Joshi, there's some other data that has come out recently as well. You would have looked at the inflation numbers and how they've come out. We have a very interesting time of the next policy too, I mean, which is, of course, the meet is, there is a holiday wedged in between the meeting as well. It comes right on the heels of arguably a new government getting elected too. What do you expect are the tools at the hand of the Reserve Bank of India when they meet, the MPC meets this time around?
Well, I think if I look at how the scenario has changed from the last policy meeting, I think two things have become clear. I think the growth slowdown seems to have become a little more intense, and on top of that, inflation was moving up. But I think within inflation, it is the core inflation which has come down quite sharply, and that again is reflective of weak demand. So somewhat weaker demand and core inflation coming down to 4.5%. I think that opens doors for another rate cut. We do expect inflation to go up in 2019-20 with the drivers changing. I think until now it was a food inflation which was bringing it down, and now I think it's going to be the food inflation which is going to push it up. And food inflation typically doesn't respond to overall demand, I mean, as the core inflation does. So our forecast for inflation is 4%, which is quite benign, I would say, given the fact that that's the central value of RBI's target. And I think in the last two fiscals we've seen it undershooting the target, and maybe in this fiscal we see it at the target. So I think the monetary policy will remain soft, and the global environment is also pointing towards that. I think the central banks in advanced countries have already softened their stance. So I think that also makes it easier for India to cut interest rates. So maybe one more rate cut in the month of June, and after that I think everybody is moving ahead by feeling the stone. So I think as the data comes in, I think things will become more clear. But we do pencil in a rate cut in June.
Okay. My final question, Mr. Joshi, are we caught between the rock and a hard place when it comes to crude? Prices, because of supply side issues, have inched up. We have an OPEC meet and OPEC plus allies meet with an assumption that doesn't do anything material and crude prices continue to stay at a point higher, at a point of time when the domestic economy is showing clear signs of weakness. Are we caught between the rock and a hard place?
Well, I think I would still regard oil at 70 being a soft oil price. I mean, it's not so much of a pain. I mean, only when it goes up to 80, 90, then we start feeling the heat. And given that from the demand perspective, the global conditions are weak, so the upside to oil will not be too much. Except I think the only issue could be geopolitical, which is hard to predict and which is evolving. So from a demand perspective, from a fundamental perspective, the oil prices should not be shooting up too much. And I think I think even up to 75 is something that the economy can easily take at this juncture.
Okay, Mr. Joshi, we'll leave it at that. Thank you so much for taking the time out and speaking to us today on the trade data and, of course, the other factors which surround the economy. Appreciate your time. Well, that's Mr. D.K. Joshi talking about what's happening with the macros. Just one quick word on what's happening in the micros as well. The markets have flattened out completely, but keep an eye out for the pharma index. that started off about 1.5% lower. And the last 7 days, it's been the worst performing index. The last 1 month, it's been the worst performing index from amongst the NSE indices. Clearly, what's happening on the global front with this whole talk of penalties, etc., is spooking the street on a space which, on a valuation perspective, is not looking all that expensive. But watch out for pharma stocks. They're certainly wobbly in the session today as well. It's a wrap on this leg of Indian Open. Up next is the FNO show. Stay tuned to Bloomberg Quint Live.